Sure. Hi, everyone. The Asian American Bar Association of New York is certified by the New York State Continuing Legal Education Board as an accredited provider. This program has been approved in accordance with the requirements of the CLE board for a maximum of 1.5 credit hours, in which 1.5 credits will be applied towards the requirement of areas of professional practice. This program is suitable for both transitional and non-transitional New York attorneys. You must have pre-registered and confirmed for this program to receive CLE credit. The first page of the written materials that were emailed to you is an attorney affirmation, which you must complete and return to CLE@aabany.org. 2 codes will be announced during this program, and I'll be announcing that. Record the codes on the attorney affirmation. And then please return your affirmation as soon as possible within 1 week so that we can send you your certificate. You received a link for an online evaluation for this session with the written materials. Please kindly complete the evaluation so that we can improve our programs. Also, this program is being recorded for archival purposes. Your continued attendance in this program constitutes your consent to transmit, record, and use your voice and image for this purpose. And I'd like to add, if you want to use the Q&A button at the bottom of the screen to submit questions as they come to mind, that'll be great. I or someone else will read the questions to the panelists towards the end. And that's it. Without further ado, I'd love to introduce our panelists as well as myself. Oh. And for some reason, my window simply disappeared. Can people hear me?
Yeah.
Okay. So I will continue while I work this out. All right, everyone. Welcome. Thank you for spending your Saturday morning with us. I am Courina Yulisa. I am a former law clerk of the Honorable Elizabeth S. Stong of the U.S. Bankruptcy Court, Eastern District of New York. I'm a little bit in between positions right now. We also have an awesome lineup of panelists here. I'll start with Vijar. Vijar Kohli is the co-founder and portfolio manager at Golden Door Asset Management, an investment firm focused on buying and building small businesses in opportunity zones. He's also the host of techfinancier.com, which is a weekly blog that discusses capital, labor, and technology. So you guys should definitely check that out. We also have Vincent Roldan, who's a partner in Mandelbaum, Salsburg, Bankruptcy and Creditor Rights and Banking Financial Services groups. He's also the co-chair of Albany's Bankruptcy and Restructuring Committee. So he should be no stranger to all of you guys. We also have William Howe, who is counsel in Alston and Bird's Financial Restructuring and Reorganization Group. He's also the treasurer of the Asian American Bar Association of New York, Albany, and a co-chair of its Commercial Bankruptcy and Restructuring Committee. So welcome, everyone. So I think in terms of the run of show here, we're going to have, and this should be in your materials as well, some general overview of the COVID impact. We are discussing where do we go from here, what types of filings have occurred, and then we'll go forward with the specific industry issues, what are the industries that are hardest hit, the strategies for mitigating the COVID-19 risk, as well as, how does this compare to the 2008 financial crisis, and, what can we do going forward? And then we'll leave about 15 minutes for Q&A session with you guys, so there should be ample time for questions and answers there. Okay, so the one thing that I'd like to start off before I throw it over to the panelists is I'd love to share some of the bankruptcy filing numbers with you guys, or at least the percentages, because I think that's just more effective. So overall, we've seen a spike in Chapter 11 post-lockdown, post-March, and that started around May. That had the biggest spike overall, and then June and July were pretty high as well. It kind of just wavered a little bit of a downward trend for August, but August is typically a slow month anyway. So for August, the commercial Chapter 11 filings increased by 17% of this year as opposed to last year, August 2019. So we're comparing this year versus last year's numbers. And that data was provided by Epic Systems. And the total bankruptcy filings, including the commercial Chapter 11, actually decreased 41% from last year. So overall, consumer filings are down. That was decreased by 42%. Individual Chapter 11s are down. It's the commercial Chapter 11 filings that have increased rapidly. And it's similar to July. They actually have a higher percentage. It was 52% of increased filings for commercial Chapter 11 filings in comparison with the July 2019 numbers. So that's actually a pretty huge jump, even though total filings are down by about 33% at that time. So we are seeing that trend in numbers where we have the initial wave of commercial filings, of businesses filing for reorganization. And then that's kind of faltered a little bit back to kind of March numbers at this point. But, I guess I'll leave it to the panelists to figure out, what happens next. And feel free, guys, to jump in whenever, if you guys have anything else to add.
Actually, I would just jump in really quickly on those numbers, which I actually think are pretty interesting and kind of illustrative of what's been going on. It's the economy between the consumer numbers and then the kind of commercial 11 numbers. And I don't know, Courina, from your experience as a clerk, and I think part of the reason the consumer or the individual numbers are down because of the access to the courts and just the court closures, and it's more difficult to actually get bankruptcy filing done in the last few months as an individual. And plus, there was obviously, this is applicable to both the corporations and the individuals, but there's significant stimulus that was out there that helped people kind of weather the last few months. But I kind of would expect, particularly in areas where courts are really starting to reopen and the individual stimulus packages have not been re-upped, that we'll see an increase in consumer filings as well in this last quarter into next year.
That's a good point, Will, and I think that's totally right, because there's just been all the court closures and also just the fact that people can't get to their attorney's offices. There's a bunch of pro se filings, that are pretty low as well right now, just because of those logistical difficulties. And then what we're going to see, it seems like, we're talking about forbearances, moratoriums, all of those things are available right now, all of the government relief. And once that ends and once people figure out, there's nothing left, I'm figuring that, those numbers will definitely increase in terms of the consumer side of things too. Okay, so I'm going to wheel the first question here for our awesome panels. So, after discussing these numbers, what can we say in terms of basically, I'm sorry here, let me see. How have COVID-19 actually impacted the cases or transactions that you're actually working on? What are some of the market trends that you're seeing overall?
Yeah, I'll begin. First off, thank you for inviting me. This is great, very informative for everybody that's participating and myself included. So, the major thing, obviously, from COVID, we're working on a case, Vince and I, in New York City. New York City's obviously been largely impacted, so the level of foot traffic at some months was zero. So any of these retailers, any of the businesses that rely heavily on New York traffic really didn't have any business opportunities to make money. That's a forced bankruptcy at the end of the day. So it's created a let's say a domino effect on everybody, from the retailers to the landlords to any of the suppliers. There's so many people that have been impacted just from the New York metro area. I'm sure the same thing is happening across the country in the top 20 cities. But it's pretty interesting to see how much of an impact it's probably going to roll down to the municipalities, which New York City alone has accumulated $9 billion in deficit in the last 6-7 months. So it's not just businesses and not just consumers that are definitely in distress.
I'll add that on that case that that Vijar and I are working on. Let's say this happens to be a high-end salon in Midtown Manhattan, right off of 57th Street. And so during good times, this salon grabs folks from corporate offices that are nearby, and the travel industry as well. Hotels are still pretty much dead right now. A lot of storefronts themselves are boarded up. I've just walking around the city. I've probably done it, say, 4 or 5 times in the past few months, and I would say the foot traffic is still not there, and the storefronts are boarded up. You'll see a lot of cars. There's certainly a lot more cars now. Where they're going, I'm not quite sure, but yeah, you don't see are the thousands of folks exiting every office building at lunchtime and at 6 or 7 o'clock at night, getting to where they need to go. And you certainly don't see a lot of tourists anymore. Also, so certainly in a like high density commercial area like New York, I think we'll see. I think we'll see a lot of we are seeing a lot of distressed entities. I think we'll probably see more filings in the near future, Courina.
So actually, let's talk about the small business filing side of things, right? And then maybe, Will, you can chime in on this first. We're seeing a lot more of the small businesses suffer. And, we're probably seeing an increased filing that's on the horizon. Now, we do have a new tool starting, last year in February of 2019 called the Subchapter 5 bankruptcy case. Will, do you want to talk a little bit about that and how that's kind of a benefit for small businesses right now, especially under the CARES Act?
Yeah, certainly. So it was pretty much, by luck, right? That, right before COVID-19 pandemic really started hitting in the United States, Congress had, it's a process that took years, but Congress had passed and made effective a bunch of amendments to the Bankruptcy Code, which provided access to Chapter 11 for small businesses, right? It made it a lot easier for them to utilize Chapter 11. Normally, Chapter 11 is utilized by, larger companies because it's expensive. It's a long and costly process. And this new Subchapter 5 provides, small businesses with a way in to utilize all the tools of Chapter 11, which is to get rid of and reorganize your debt, get rid of bad contracts, have some leverage to negotiate with your creditors, but to do that on a much less expensive level and a much quicker process as well. So we had that go into effect, February 15 of 2020, and then,
2019.
Oh, okay, yeah. And then, COVID hit, and then through the CARES Act, Congress actually expanded the access to Subchapter 5 by raising the debt levels that are required. So before the CARES Act, it was about 2.5 million or 2.8 million, I think, as the maximum amount of debt that you could have in order to utilize Subchapter 5. And then under the CARES Act, they expanded that to, I think, about 7.5 million, right? Which, opens the doors to a lot more companies in order to utilize it. And I think, companies have been taking advantage of that in the last few months, right? But there are also some other things. Obviously, people have heard about PPP, the EIDLs, and all the other government stimulus packages out there. And that has also provided a lot of, kind of float or a runway for these companies over the last, 4 or 5 months, right? To try to figure out what they're going to do, whether they can make it out of the other side of this pandemic, right? And so the number of filings, I don't know if they've gone up significantly for small businesses in the last 5 months, but they're definitely, hitting that wall now, right? A lot of them are getting to the point where if your money is running out, that 24-week initial forgiveness period is running out for most of these companies. And, we don't know yet whether there is another stimulus package on the horizon, right? So there is, a lot of activity in that area because, and again, do at least now have the opportunity to utilize a Chapter 11 process and buy a little bit more time, right, for the next 5, 6, 7, 8 months, right, to kind of see what happens, as opposed to, before these amendments were enacted, we might be seeing a lot more liquidations. So I think we're hopeful that they'll be able to utilize this and come out and find a way forward after the pandemic by utilizing Subchapter 5. But I think that kind of still remains to be seen.
Let me add a little bit of color. One thing about the Subchapter 5 process is it's designed to be cheaper. It's designed to be faster. Like Will said, it just by happenstance, it was enacted just before before the pandemic. However, what I'm seeing right now is the normal deadline in a regular Chapter 11 case is 120 days for a company to file a plan, and there are extensions if the company is making a little bit of money and complying with its obligations, and certainly talking with creditors, the court will give some rope. Because Subchapter 5 is supposed to be a faster process, they cut that time from 120 days to 90 days to file a plan. So practically speaking, what does that happen? Let's say the world is over and March or April, they start filing. So we're right about now, we're hitting that 90-day mark right now. And I, in fact, in one of my two of my cases are hitting that, and I'm getting extensions. So it's designed to be faster, but during COVID times, we need the opposite. We need we can't have it in and out, because 90 days is not enough for the company for the bankrupt company to deal with all the impact of COVID, the lack of revenue coming in. We didn't even talk about the operational changes that come in just to make the workplace safe, limiting not just foot traffic outside the door, but traffic inside the door, to make it safe for your customers and for your employees alone. So yeah, I think the Subchapter 5 provisions are terrific, and what I'm seeing is the courts are a little bit lenient with those timeframes. At one point, it was supposed to be designed to be fast, but I think this is a different era. I don't think speed is what we need. We need kind of patience and information and collaboration among the all parties.
Yeah. Go ahead, Vijar.
I'll just add something. One additional variable. So Subchapter 5 is pretty new, which is it definitely is helping a lot of companies below that $5-7 million mark, or below 10 million in revenue, let's say. But the additional variable that they haven't figured out yet is that the PPP loans and the SBA loans are very new financing structures. And the SBA loan is a 30-year loan with a low interest rate, but it's a new creditor on the list that was just added in May, June. And then the PPP loan is very unique because it has a short time window, so it goes along with what Vince is saying. Not everybody can have their PPP loan forgiven in that 90-day period or that 24-week period, depending on what it is. So it's yet to be discovered how it's going to be handled, whether you have it on the books or it's completely forgiven.
No, I definitely want to come back to all this PPP, EIDL stuff. I think it's really interesting in terms of how they get dealt with in bankruptcy. But I wanted to circle back to something that Vince said. I thought it was actually really interesting on the SBRA, right? It was one of those provisions that's, obviously it was untested because it would be the first 90-day period that had run from February. But on the statute itself is a little bit ambiguous in terms of extensions and what the standard would be for extending that time frame for filing a plan under SBRA. And as Vince said, the purpose of it was to make it quicker and cheaper for small business debtors, but they do actually need time. The whole benefit right now of filing for bankruptcy is to have that additional time. And this is the same for both small businesses and large businesses, right? The trend in Chapter 11s for large corporations has been these prepackaged in and out bankruptcies where you kind of limit the expense and cost of lawyers and financial advisors and all of that, and transactional costs in going through Chapter 11. But what we've really seen in the last 5 or 6 months, which I think is really the biggest indication of the utilization of Chapter 11 right now, is that there's a big increase in what we call free fall bankruptcies in which the company has to go in, And this is closer to how it used to be, prior, 10, 15 years ago, which is, they go in because they just have creditors and they can't deal with them, and they have to go in and get some time in order to figure out how to deal with their debts. And so we're seeing a large increase in those types of filings, which really, it just shows that why they're filing and why they're trying to get out from under the real uncertainty of COVID-19 in order to, buy some time in order to move forward, both on smaller companies and large companies.
And it impacts the exit. Sorry, Courina. I just want to add that the end game of any Chapter 11 is to get out of bankruptcy. And how do you get out of bankruptcy? Traditionally, you get out of bankruptcy by you pay off your lenders, and you figure out some way to your unsecured creditors. Maybe you get new money and you pay off your unsecured creditors that way. But in a traditional bankruptcy, you lose control of the company because typically there's not enough. Typically, you can't pay all of your trade creditors in full. You can't pay everybody in full, and so the owners lose the company. But the Subchapter 5 is designed to enable those small business owners to keep their company. They maintain their equity, and they're able to pay some portion of disposable income I think it's over 60 months, over 5 years, to pay those creditors. And there's the rub. So COVID's impacting exit, because what does disposable income mean at a time when the company is operating at 50%, 40% income during normal times, projected to do so throughout all of 2021 as well. So this will certainly be interesting to see how much rope the courts give us. I'm particularly interested for my own clients, and ultimately I think my hope is that it will encourage folks, creditors in the case, to be realistic and figure out some creative mechanism to make the bankruptcy case work, because the shutting down a company is that's not the answer to anyone's problems.
Right, and what I was going to say is there's certainly a sense of urgency now more so than ever, and that's why the free fall bankruptcies have been increasing. And that certainly does pose somewhat of an issue in terms of Subchapter 5 filings because of those tight deadlines. So, a lot of times people recommend that, you should do a lot of the work in advance before filing. Sometimes that's not possible. And from what I've been seeing, at least in terms of, the Eastern District of New York, is that judges generally have been understanding of the issues that COVID-19 and the lockdown has posed on the parties, on the attorneys, and maybe the lack of availability of documents, whatever it is, right? So we've seen those deadlines get extended for logistical reasons, for practical reasons as well. And I just want to put in a disclaimer that my views do not represent the U.S. Bankruptcy Court or Judge Stong in any way. But in terms of my observation, it's certainly true that judges have been more understanding during this period, but they still have the consideration of how do you move the case forward? What's actually viable? Do you guys have an exit plan when you're entering these Chapter 11s or Subchapter 5? And if not, what happens after that? So those are certainly considerations that still need to be, that you guys still need to keep in mind as you're filing these cases, because they're still interested in making sure that these cases are viable and that they go forward. So at least that's what I've been seeing from the court's perspective. So I guess let's move on to the next question. I'd love to go into more of the industry-specific questions, and I'm sorry if there's any background noise on my part. So in terms of the specific industry issues, what industries have you been seeing that are hardest hit by COVID-19, and what are the companies doing to deal with this type of disruption? I don't know if anyone wants to answer that first.
I'll take a crack at sort of, I guess simultaneously as a bankruptcy attorney. I think it's almost easier to talk about what types of companies are not impacted by COVID. I mean, any company that relies on customers on those sorts of transactions to make money, which is that's everybody, right? They're all impacted. My wild guess, without any having researched it, my wild guess is tech companies are doing quite well. And anyone that with a online presence that it shifted early on to an online commercial transactions, they're doing just fine as well. But certainly in the retail was struggling before COVID hit, and now it's absolutely crushed. So retail, restaurants were not doing well before COVID. Healthcare was not doing well before COVID as well. That's being crushed too. I kind of make a dark joke that it's easier to, in terms of retail, it's easier to take a guess. It's easier to guess what companies will not be in bankruptcy than it is to figure out who will be in bankruptcy. Century 21 just filed about a week ago, right? Century 21's been around a while. My wild guess is Macy's will be in eventually. My son was horrified when I told him that Pizza Hut and Wendy's were both in bankruptcy. That was a couple of weeks ago. So he made me rush out, take him to go to Wendy's so he can make sure that he tries it before it goes under. But like certainly anyone that relies on non-online purchases, person-to-person transactions are affected. In terms of what companies are doing to deal with it, like I guess for basically to take a step back, it's ultimately it's a cash flow issue. Companies are experiencing incredible disruption to their own supply chains, impacts their inventory, operational costs. It makes it just to simply do business. It's much more expensive to do so. Reduced demand as well. I think the demand is out there, but folks are they're trying to grab what they can online and without going out to the store. So you have the reduced demand. Ultimately you have lower revenue. So companies they need to hoard cash right now. They have been hoarding cash, and they need to hoard cash more. I don't know, but many companies that are spending a lot of time investigating, expending a lot of resources on new investments, on new M&A activity. They're doing the opposite. They're curtailing their expenses. In terms of those operational costs, these are some non-recurring expenses that no one would have foreseen. To clean your workspace and to keep it clean, to keep your employees distant. So they're basically putting plexiglass all over the facilities to improve the tech infrastructure. I think that certainly a lot of companies that they might benefit ultimately, because it's my guess also, without having done the research, is that a lot of companies they really needed to update their tech 2 years ago, and now they're kind of forced to do so in order to adapt. Training for the employees. Who's going to implement all these operational changes? Who's going to implement all these new fancy new technologies the company needs to use? How do we reach out to customers? Now we can't. It's the whole concept of advertising and marketing is changing as well. I'm seeing certainly a shift that should have happened a couple of years ago toward online marketing, using social media, using influencers to the benefit. How do companies typically get funded? Typically, the small and medium businesses will get funded through some usually a credit facility. Companies are taking a look at what covenants in that credit facility are they in compliance with. Every credit agreement will have reporting obligations, financial disclosures that the company will need to meet. And my recommendation is always to meet and disclose and address it head on. But yes, the company is looking at those credit agreements to see what options they have and what their rights are. Are they going to get shut off by their lender? right now, in terms of how to deal with this disruption, I can certainly talk from personal experience. The monkey in the room, or the elephant in the room, is the landlord. Oftentimes, they're paying rent on a space they're not even using. So my suggestion has always been negotiate with that landlord, come up with some realistic rent obligations. I've certainly seen a lot of folks. These are, like, say, some gyms, for instance, gyms, restaurants, bars. They're flipping the keys to the landlord and turning them over because it just doesn't make sense for them to continue operating. And these are typically those retail shops that should have been that had trouble even before COVID. But yeah, to the extent you have a viable business, and there are some good viable businesses out there, including John Barrett Salon in 57th Street, right, Vijar? The point is, negotiate with the landlord. Does the landlord really want an empty storefront for the next 2 years? My guess is that the landlords will be reasonable because they like having a viable business as a tenant, and they don't want the empty storefront. The landlords have their own credit agreement concerns as well, and they'll probably blow their own covenants with their lender if they have these empty storefronts. So they like having tenants even at reduced rent obligations. So look, I guess the solutions are common in any era, with or without COVID. You negotiate with your main creditors, like a landlord. You hold on to cash, reduce those cash payments, try to defer, try to get as much credit as possible, and just talk. It's easy for me to say as a lawyer, but just talk and ask. You don't get what you ask. You don't get what you want unless you ask for it. Taxes are a big item. The IRS will work with you to defer taxes, and that could be a great savings for the company. And keep. I'm actually super shocked. A lot of entities that I've spoken to, a lot of companies I've spoken to, they really don't have a budget other than what's in their head. Really need to sharpen that pencil and come up with a cash flow budget. 13 weeks is pretty standard. And now I know it's difficult to guess what it looks like today versus 13 weeks, but I always advise clients that they need to. It'll help them. It'll certainly help them evaluate their own business going forward, and it'll help them talk with their landlords, talk with their lenders, and also attract new money if they need that. Ultimately, it will come down to what your existing contracts say. So read the contract, check the notice provisions, for instance, see what see if you're entitled to any extensions of time. Try not to blow your contractual obligations, or use the extensions, use the cure periods. But if there are simply progress reports, a lot of contracts will have early warning covenants, notices of some anticipated delay. Keep good records. So that seems to be a simple fix, but certainly a lot of the smaller companies, their records are not very good. So more records to keep cleaner. Try to keep them clean, and it will help you certainly get that new money coming in. Companies are testing the contractual, or I would say the equitable principles of force majeure, frustration of contract. I have not seen these terribly tested. I've used them in court without having to litigate them. There was a concept. I think there was a state Supreme Court decision that determined that COVID was not a governmental, was not an act of government or something to that effect. It was not a reason to forgiveness of the contract based on a governmental mandate. That's an important decision. That will impact a lot of bankruptcy cases that we're trying to get out of rent for that reason. So the companies need to come up with other creative means to delay payments. So on the flip side, also reviewing contracts. On the flip side, companies are, like, I'm representing some borrowers also in some credit agreements. They evaluate these new contracts, figure out, try to insert provisions, COVID-friendly provisions, try to anticipate the unanticipated. Again, so I am seeing that that the COVID is now leading companies to there are a lot of circumstances during which you don't realize something's important until it's there. Well, now we have evidence that there's a pandemic, and so they're building those force majeure type provisions into their contracts, and also build their credit and early warning signs type provisions into those contracts. Basically, to foresee the unforeseeable. So, hope that helps.
Okay, sorry for the interruption, guys. Anyone else?
Yeah, no,
I thought Vijar. Oh, okay. Well,
no, go ahead.
Yeah.
Go ahead.
Yeah, I got some things so I could chime in real quickly. So quickly about retail foot traffic. I'll try to talk about New York given the chapter's name and all of our proximity to the city. But it's most important to think about the first retailers on like Fifth Ave and areas in Soho. A lot of those are flagship stores, so those are naturally money-losing entities. They're not designed to be profitable because they want foot traffic to build a brand. Vince already mentioned the other retailers that are non-branded. Those guys were already struggling because nobody's buying in store as much. But the really important one are the restaurants and the hospitality businesses. So restaurants naturally usually only have 15 to 20 days of cash on hand. So they're definitely not prepared to close down for more than a few weeks. That's very, very rare. Restaurants need to be operating at 80% or something to be really, really doing well in business for the month. So they can't afford rainy days and snow days as often as other businesses, such as law firms. And the hospitality, obviously in New York, the hotels, this is the first time we're seeing some major brand names in New York City that have been around for probably even 100 years. The Times Square, I think Hilton shut down for the first time ever, which is something you would never expect, given that they probably are doing less than 10% in business at the current moment. And what I think is most notable for most corporations or even small businesses, if you have one entity or just one location, then you can really handle that type of cost. You can figure out how to work with your fixed costs, such as one landlord, one operating agreement, really. But if you start to have multiple entities, Century 21 is a notable one because they have 4 or 5 major stores. They simply don't have the working capital to finance 4 or 5 of those if they don't own all the real estate. Macy's is another good example. Their flagship store probably is not doing much in sales, but I think they own those assets. So they'll probably just siphon that individual building, put it to the side, but they probably will have to shutter. I think they're shuttering 30, 40 of them across the country to accelerate their plan. So if you have more than a few physical locations, I think it's much more strenuous. That's why hospitals and major franchise brand names are definitely struggling at this point.
Yeah, look, there's a lot here to talk about on all these industries, and I think it's funny, right, Vince? We were here maybe 2 years ago talking about the fall of retail, right, and at a fall conference, and talking about Amazon and all that, and that's only just accelerated further with respect to retail. There were a couple of industries that were in distress prior to the pandemic. There's retail, oil and gas, and healthcare, and that's all kind of continued. Healthcare's kind of restructuring slowed down a little bit just because I think most people are waiting for the election results to see what happens because it's so tied to regulatory issues and the administration that'll be in play. So there were a lot of those restructurings early on, but I think that's kind of calmed down for at least a couple more months. But back to kind of retail, it just it really, you were talking about Macy's and that one and a lot of those other kind of larger department store chains, what they've been trying to do, right, is to, if they own real estate, right, to respect to the locations that they actually own the underlying property, they've been trying to, separate out those assets from their kind of operational assets, right, and try to be able to monetize the underlying, real property, right, and that was kind of a strategy going into the pandemic. But now, commercial real estate is really kind of the big elephant to me with respect to this pandemic and what's going to happen there, and whether that value is kind of starting to dissipate, and that strategy may no longer be viable because who knows how people are going to value commercial real estate, for one with retail, right, and plus and office space, right, and especially in the first, couple of months of the pandemic, we really saw how that very kind of fundamental, which is, to me, drew a parallel to 2008 with residential home prices and how that kind of reverberated through the economy. So the commercial valuations and the ability to collect upon the underlying mortgages and the lending that occurs, right? Because it goes through a whole structure, right? You have the landlords, you have the retail offices, and then you have the loans, right? And the loans, in a lot of cases, commercial loans are usually larger loans that are either on the books of the banks or they are securitized and they go into different structures. And those structures issue notes, and those go into large institutional investors. And then you have all these entities that service those commercial mortgages, right? So you have this whole ecosystem that overlies commercial real estate. And at each level, they were all stressed, right? One, there was a moratorium on evictions, right? You couldn't actually file any cases or on non-payment of rent. You couldn't really exercise any remedies. And so in those structures, those servicers are still needed to pay all the note holders under their underlying CMBS structures. And they were facing liquidity defaults, right? Because they didn't have enough reserves to pay out rent for every single loan, right? That was not being paid, right? Because the rent wasn't flowing up to them on all these structures. So that was, and that's kind of calmed down a little bit, but that has gone back into the direct level of what Vince was talking about, which is the negotiation between the tenant and the landlord and how that all works out and how that looks going forward. So again, this kind of goes back, there's just so much that's still unknown and how all that's going to work itself out and how people are going to be able to see value. And to me, that's been the biggest issue, right? And the reason why we've seen all these free fall bankruptcies is because it's hard for the counterparties to really agree on value at this point, because you don't know what cash flow will look like after the pandemic ends, right? Or if it ends, or what the world will look like, when restrictions start getting lifted a little bit more, and what normal will be in 3, 4, 5, 6 months or a year from now, right? And so how do you predict what your cash flow is going to look like and what your business is going to look like? What is a viable business structure? And then how do you refinance an underlying business under those circumstances? And so buying time, I think, is probably the theme right now, particularly without a stimulus float currently. And I think we're all kind of in a holding pattern. But in the meantime, you're going to see a lot of companies, like, they don't have cash now. They don't have cash to run out that time. So they're going to need to seek bankruptcy help and help from the courts in order to do that.
One thing I did neglect to touch on commercial real estate, because that's an important aspect of it, something we see. It's not just about the retail folks. Again, back to my own anecdotal evidence of the lack of foot traffic in Manhattan and the lack of folks streaming out of office buildings. Financial services companies and law firms also, and so insurance companies. I'm seeing that they are cutting their leases or they're significantly reducing the footprint in whatever office space. So what's the purpose of having a fancy office building if no one goes in it, if you can't entertain clients in it? Companies, they certainly were looking for ways to cut costs even before COVID. Commercial real estate was I wouldn't say distressed, but certainly commercial real estate was down last year. The value of the real estate was down last year. Now it must be, my guess is even further, because companies they're realizing, wait, I can have all these workers work remotely, and I don't need to have that fancy New York Midtown office space. So I guess we'll see. It remains to be seen how that impacts the significant portfolios of commercial real estate held by these funds, and where is that going to go ultimately?
Right, absolutely. Oh, I'm sorry, Vijar, do you have something to say? Oh, okay. Well, no, and these are all really good points, and this is such a huge discussion that we can probably spend all day on this. But it does make sense that there's going to be a lot of valuation uncertainties, that commercial real estate will be really a big factor here. And I think that also goes into, what types of companies are, filing for bankruptcy first. It's going to be those who are more highly leveraged, who have like basically less liquidity, and a lot of them have already planned or have been considering Chapter 11 filings as well. So it makes sense for that first wave to have all of these types of industries and companies doing so. And the ones that are a little bit more secure, the ones who have more liquidity, and those are the ones that are going to be assessing all of those issues now. And certainly with the courts, we are seeing more disputes over valuations for sales plans that include sales of commercial real estate and as well as residential real estate. So I think that definitely is true, at least in terms of what we're seeing on our end. All right, so I think this makes sense. Specific industry issues are pretty much rampant in a lot of them. So the next question that I have is really, it seems like, what are some of these strategies then to increase liquidity, since it's so important? What are some of the corporate strategies when you're thinking about dealing with distressed customers and also distressed suppliers, right? What can we do to basically preserve that liquidity, increase it in any way it can, and also mitigate those risks as well? Another big question. Sorry for the two-parter, guys.
That was like an 8-part question. In terms of how to deal with.
So at least we can take it by steps. Yeah. So let's talk about increasing liquidity at least.
Yeah, I'll start off. So, the biggest thing is to preserve cash. Fortunately for a lot of small businesses, they received a quick injection. If you're running a payroll of, let's say, $500,000 a month, then you probably received at least $1 million in PPP loans to cover payroll that provided a significant amount of financing in a very short period of time without any approval. So right there, a lot of these companies received a lifeline at that moment. Obviously, the SBA loan provided another 5 to 6 figures of more capital. That's very, very cheap capital. I think it's at like 2-3%, 30 years. So both of those lines, you could easily get 6 figures to 7 figures of dollars just coming in to finance your business. The problem is, one, Vince mentioned it, companies aren't doing their budgeting or their cash flows, so they have no idea what their position will be like. The biggest thing to preserve cash is to, one, increase sales or reduce expenses. So in this case right now, you have to work with your vendors and your lenders and your landlords to fight off any contractual payments, reduce fixed payments, maybe make it variable, or just to extend payments so they're at the back end of leases and contracts, because it's not reasonable at the current moment to be on the same path that you were on this time last year. It just doesn't make sense because these companies don't have the liquidity. And the real problem earlier in the summer was that companies were opening up step by step or phase by phase in June, July, August, and now September. One, they didn't have enough capital because they didn't have enough revenue coming in, and they didn't have enough cash. And then two, they don't know when their businesses are really going to pick up again. So New York, I think yesterday just mentioned they're going to open up permanent outdoor seating. But the reality is that, that outdoor seating is only going to last for so long. So indoor seating has to come back for restaurants to really do well. So we'll see how this works, but it's really difficult to figure out what your business is going to be like if you're really a month-to-month business at the end of the day.
Yeah, I just jumping on that real quick. We represent the Il Molino restaurants. It's a chain that's in bankruptcy right now, and all those things reverberate with me, right? It's early on there was kind of it was unclear what the legal framework would be, the regulatory framework would be with respect to reopenings. There were a whole bunch of phased reopenings or reopenings that started up and then they had to close back down. Other, especially in Florida, they did that a bunch of times, and the cost of getting back up, right? Especially for, like Vijar said, a restaurant, which is already really, really low margin, and they really make most of the money on alcohol, and then they couldn't open the bars and they couldn't serve alcohol, right? And so it made it very, very difficult. And so how do you actually survive, and how do you actually get capital, right? They usually they don't own their real estate most of the time, and so yeah, I mean it's a lot of it came down to stimulus packages, right? Having PPP and having SBA loans to help them get through this time period. Like Vincent was talking about earlier, it's the landlord and trying to that's usually their major expense, and trying to figure out whether landlords will be reasonable, right? And when you're a restaurant chain that has different landlords all across the country, you're dealing with all different kind of views with respect to everything, right? You're not dealing with one single counterparty, and then you're dealing with different locations, right? Different areas of the country. Makes it very, very difficult, right, to come to a comprehensive restructuring plan, right? A comprehensive way forward with respect to your business. And you really, it's the type of business that doesn't have the capacity or the cash on the books to deal with those types of restructuring costs. So it does make it really difficult. Just really quickly on the landlords, right? I think it's been interesting. I think from my experience, we've seen a pretty wide variety of responses, but generally, I think they've settled on being pretty commercially reasonable and trying to share the pain with their tenants overall. There's definitely some that have taken positions and have really wanted to stick to their lease agreements that they went into the pandemic with, but most have been able to say, look, when you open, right? When you open, maybe you start paying me back some of the rent that was missed over those months, right? And I think that's been a pretty decent baseline where you can at least abate the rent, right? You don't actually have to pay for all those months that you're closed, or maybe you tack it on to the end of your term. You have a balloon payment or something like that, or you just basically kick it down the line and deal with it later, right? Because for the landlords, real estate is always it's usually a long-term play. But then there's others who have been even more aggressive or more helpful in terms of saying, look, we can forgive all that rent. Maybe we just start with when you reopen, right? Again, you don't know how much is going to reopen, how much your revenue is going to look like. We'll just take maybe a percentage rent in the first year, 6 months, or whatever it looks like, right? We'll just start getting a little bit into the door. Help me cover my underlying taxes and other typical rent underlying lease costs, right? So we can deal with that. And then you have things like in JCPenney's where the underlying landlords are actually buying the business, and they're taking over the businesses and injecting it and keeping it moving forward, right? And so it's kind of interesting, again, how all that's going to work out and how the landlords are figuring out their strategies, right? Because this is, I don't want to sound, way try to pull this out of proportion, but it's a little bit of an existential crisis for commercial real estate right now, and how they figure out what to do with this going forward will have a big impact on values for them in the next 10, 20 years, I think.
Will, you raised a good point, and I want to ask you or touch on something you mentioned. I happen to love Il Mulino. So aside from the operations changes and aside from just the decreased demand, decreased customers, I'm seeing that COVID they're affecting the whole, almost like the whole purpose of being, like a small intimate restaurant like an Il Mulino. I'm seeing a lot of other smaller intimate restaurants, they simply can't operate. Is there a lot of, I don't remember there being a lot of outdoor space in the Greenwich Village for Il Mulino to service even 2 tables. And that's just one location. I do represent a lot of, the fair amount of restaurant owners that they simply can't exist as they initially planned. It is unfortunate. The flip side is I actually do know 2 restaurateurs that are actually opening restaurants. And who the heck is opening a restaurant during these times? They're opening restaurants to take advantage of this new era where kind of reverting to takeout, reverting to delivery, significantly reducing a footprint because you don't need space for 25 tables anymore. You really just need space for the kitchen, for the countertop, and a little bit of space inside for folks to come in and pick up their food and leave. And that, I haven't quite seen that model tested just yet, but I do find that interesting. I certainly would love for there to be a time when everyone can go out to nice restaurants again, all types of restaurants. And I don't really want to see a strip mall filled with like individual stalls of takeout storefronts. But that could be what we're seeing, especially because these restaurants were not doing very well to begin with, even before COVID.
Yeah, I think it's going to be interesting how this all plays out, right? And I think we'll probably touch upon this a little bit later, but there is still a lot of money out there. There's a lot of people looking for opportunity, right? I mean, look, the restaurant industry was never great, right? It's a little bit hard to commoditize, and it's also just very low margins, right? So until they can kind of figure out something that helps change the underlying economics, I'm not sure there's going to be huge lifelines out there to really help all these, these kind of, and restaurants too, they're very much mom and pop, right? It's one of the kind of last remaining industries where it is very much mom and pop. So, in the past, you would think, well, this stuff will get rolled up. Big money comes in. They try to, take advantage of synergies, and you have a big fund or something, or a PE firm that comes in and puts it all on one flag and try to, make some money that way. But, not sure that's going to be able to happen right here with the restaurant industry.
Yes, and I'm seeing also, at least when I was a clerk, that there's been a lot of restaurant Chapter 11 filings that had to convert to Chapter 7 liquidations, just because of there's just money drying up. It's no longer operational, and really also the other interesting factor is the investor side of things, right? And let's get into that a little bit. What's the investor perspective at this point? What should they be doing to protect themselves? It seems like they're really at risk here. And also, what are some of the opportunities that are available for them right now? I don't know if anyone wants to start on that one.
Look, there's certainly opportunity, right? And for investors, right, some of them, they're paying now for, it's not paying, it's just a factor of the market, right? There's very loose covenants. There was a very past 5, 6, 7 years, financing is very loose covenants. There's very little oversight with respect to their collateral buckets, and so they're kind of, that stuff is getting tested now, right? The whole J. Crew thing, I think we're all familiar with in our industry, how trying to get around the financing structures that they've gone into, and so there's definitely risk, but again, there's also tons of opportunity, right? This is kind of unprecedented distress. It's a matter of figuring out where you envision valuations to be, and and there's all these companies out there are looking for investment, right? They're all looking for capital, and so there's definitely ways in, and it's really just identifying what you want, right? And I know from the beginning, the folks sitting on all of this cash, right? There was already a ton of cash that was not deployed prior to COVID. I think from the minute the pandemic hit, all these folks, they sat down and they started making a list of types of businesses or the projects that they wanted to enter into as a result of the pandemic. And I think the last few months has been people trying to verify what their projections would be, verify what their visions would be, and you're starting to see people are executing on some of those strategies already. And so there's a lot of money out there, there's a lot of opportunity. Some of it is just people on the ground trying to yourselves in front of the right people, sell those things to people who have who are looking to invest, and make those connections, which is what we do on a day-to-day basis anyways in structuring. But I think it's a little bit heightened right now, just because, again, just all the uncertainty, but helping to bridge that gap is something that we're trying to do on a day-to-day basis.
Yeah, I would include that first, to go back to Chapter 11 to Chapter 7. I think the Chapter 7 liquidations are probably going to increase. One, there are probably a lot of cases that are not salvageable. So there's a lot of assets that need to be sold. So that alludes to the 363 sales. So Pier 1 imports is one good example. I think they filed bankruptcy weeks before the COVID hit, and maybe February. And then in April, they had to do a 363 sale, or someone came in and bid, and someone just bought some of the branded assets, the IP, the email list, and 2 or 3 other things related to the business, and the inventory. So I think they put up like $30 million. The company was doing a couple $100 million the year before, but it wasn't profitable. That business supposedly is already, cash flowing profitably as an online business with just a Pier 1 brand name. And you have to imagine that nobody's really doing home furnishing shopping at the Pier 1 because they're liquidating the retail stores. So any of the competitors in that space, if they have branded IP, someone can easily buy it and just give it some arbitrary value, and they'll use that against the creditors. But that's how a lot of these cases are going to go. So there are a lot of the foot retailers that still have a very strong brand name with, a large portion of America that can go online with a much cleaner and leaner structure going forward.
Let me add to that, because I actually represented a buyer in the Pier 1 case. This was a robust bidding process for the IP. My buyers ultimately they bowed out. They were in the bidding for a little bit. The way, I guess, take a step back. The way sales work in bankruptcy is there's an auction. The court sets up an auction. Even before that, the court has the selling company send out notices to try to attract buyers, and the whole purpose is to maximize, to get the best price, highest and best price for this asset, and take that money and pay it out to creditors. So as to what just Vijar said, you'll have good brands. Pier 1, a very, very well-known brand, and that their main asset will be, it's not the leases, it's not the storefronts, it's not the inventory, it's that IP. It's the ability to slap on that Pier 1 brand onto pieces of furniture. I happen to have represented a competitor in this space with a large online presence, and then Pier 1 ultimately was purchased by an entity with that vision. I don't think the purchaser of Pier 1 was actually in the space just yet. I think there was part of a portfolio of companies he owned, and this fit perfectly in that portfolio. I forget his name, and I forget. I want to say like it was a lot of a guy in the restaurant industry. I forget what business, but it goes to show that that investors. This was a process, about a 6-week process. It was run fairly, and it achieves its purpose. But that's an example of there is some dry powder out there. There is some money out there, and for the right brand, for like a A+ brand like Pier 1, there will be some interest, a lot of interest in this case.
And it makes sense that, this is an opportunity for companies to really take stock of what's valuable to them, what's their largest asset, and how can they leverage that. So going back to my, 8-part question, what are some of the strategies for dealing with distressed suppliers now that we've seen the investor side and also the customer side?
Well, dealing with, I actually don't think I answered your question about the customers. I'll answer that real quick. We're focused a lot on what restaurants are doing. Let me just, I guess I'll create some hypothetical company that sells widgets, and they sell widgets to other commercial buyers. And what happens, because that your commercial buyers are also distressed. And how does the company deal with that? Because it'll impact your cash flow ultimately. Companies need to look for the signs of of distress. Right now, it's kind of easy because the companies are probably seeing a lot of missed payments from that customer, or at least delays from that customer. I'm seeing a lot of, let's say, lawsuits mounting up against that customer, and that will impact that customer's cash flow. That'll impact my company's cash flow also. Employee turnover, and just general news. Keep an eye on the news industry. Is that particular industry distress, and many are right now. So how do we deal with that? I guess there's a wealth of options under the Uniform Commercial Code, but even before you get to your legal remedies, I do always suggest to companies to try to figure out what their non-legal remedies are. Can you do things like extend credit? Can you simply increase the price or back end the price somehow? Can you get guarantees? Can you try to get a security interest on some other asset to try to basically help this buyer out? Because that ultimately will lead to greater revenue on your end. On the UCC side, I have litigated in court certain remedies of the company who's dealing with a distressed buyer. There's under the UCC, you have a right to withhold delivery of any goods unless you get what's called adequate assurance of performance. If goods are in transit, if they're on some boat or some train, you're entitled to stop transit of those deliveries until you get payments. You're able to reclaim those goods. Let's say you sold those goods to that customer, and you believe that customer will be in bankruptcy. You can send what's called a reclamation demand letter and take those goods back. And there are strict procedural requirements under the Uniform Commercial Code. Ultimately, tread carefully because the customer is probably contemplating bankruptcy, and bankruptcy triggers a whole host of rights of that bankrupt company that I think that would be probably a topic of further discussion. But just know, if your customer is in bankruptcy, any payments you receive shortly in the 90 days before that bankruptcy, that could subject you to a lawsuit, a preference lawsuit, a clawback lawsuit. That's not to suggest to not turn down that money. Take as much money and take it as early as possible. And just deal with the consequences. Later. If they do file bankruptcy, I do suggest you call up someone like Will or me or Courina. Courina is about to join the private practice. She didn't say that, but congrats, Courina. Contact your friendly bankruptcy attorney. Understand your rights to litigation. The litigations are stayed. File your proof of claim. Figure out if you have any claim for any reclamation claims, any administrative claims for goods you sold before that company went into bankruptcy. Get some free intelligence. I do like to let clients know that once that customer is in bankruptcy, you get a lot of free intelligence, public intelligence on the company itself. Now, on the supplier side, if you're that widget company, and you're the parts you make those widgets, if that is disrupted, again, you look for those signs of distress on your supplier and then try to identify those issues early. Figure out realistically, is this an important supplier? If this supplier is were to close its doors, how would it harm your business? How immediate would that harm be? Is it feasible to find another supplier? Is it feasible to nothing simple. Is it feasible to increase your inventory of whatever that critical supply is? I know in our that salon case that Vijar and I are working on, these are some high-end hair and beauty products that, these are specialized products that we need these suppliers because companies are, our own customers are coming to our salon for these good high-end products in addition to the hair cutting, but they're not. These aren't products that can buy off the shelf at the CVS. These are high-end products that are very, very specialized. So figure out how important those suppliers are. Likewise, on the Uniform Commercial Code, it gives you rights if your customer is distressed. The Uniform Commercial Code gives you rights if your supplier is distressed as well. they deal mostly with damage claims. You get damage claims for, let's say your supplier can't supply you goods. You have to go out to the market and get substitute goods. You have damage rights, causes of action to get what's called cover damages, the difference in the cost in getting those substitute goods. Under rare circumstances, you can try to compel performance, that's called specific performance, and get that remedy. Highly limited circumstances, I actually have not seen it. But I've seen it threatened often enough, but I haven't actually seen it. And again, before you resort to these litigation remedies, I do suggest folks use try to use their business solutions. Maybe you raise your prices. Maybe you get prepayments from the supplier. Maybe you try to arrange for a short-term credit agreement for the supplier. There are some business remedies that you could try to pursue without even going to court. You know, seek relief from your own lenders if your supplier is troubled. Yeah, companies ultimately will have to go seek relief from their lenders. Ultimately, with any distress situation, the communication is key. Communicating with those customers, those suppliers, and those lenders. Certainly on the lender side, I am seeing that that lenders are amenable to at least talking and relieving the company from certain obligations, knowing that there hopefully is a light at the end of the tunnel. For the time being, I guess it's bankruptcy courts will be very busy for all of us, and we'll see how these interchangeable parts or relationships will play out in court.
Yeah, just look. I think everything been said is right. And it's actually funny. I spent like an hour and a half yesterday with a client in the chemicals business, just giving this presentation. Right, the how do you protect yourself within the supply chain? How do you see the warning signs of distress with your customers or with your suppliers? What do you do? Right, what do you do to protect yourself in that? I think the only other thing I would ask is that I would add, which is I think is interesting, is kind of the things that are industry dependent, right? There's a couple of industries out there that come to mind to me in particular, like auto and aerospace, where they're very tight supply chains. It's not even really a chain; they're like webs. And I don't know if people know how they work, but like in an airplane, all the little parts have all little parts to them, and there's little companies that make the little parts that go into the bigger parts, and all those bigger parts go all the way up to Boeing, and then Boeing kind of puts all this stuff together, right? So you have this huge supply chain, and so both for auto and aerospace, and so when you have distress within that industry, right, like in aerospace, right, Boeing's been kind of floated, and they've gotten some things through the CARES Act, and they were already about to head into distress because of the 737 MAX issues. Right? Kind of forgot about it a little bit, but that was kind of big news right before the pandemic. But how does that supply chain kind of survive? Right? We already just saw a filing, I think earlier this week, for one of these suppliers that were within that supply chain for Boeing. But typically, what's happened in the past and what happened in 2008 with the auto industry, a lot of this, the guys up top, the ultimate manufacturers, they basically have to fund everything, and they end up being kind of almost guarantors with respect to each level of the supply chain. And so when you're kind of a smaller supplier and you're dealing with everyone around you, it's almost like a little family, and they all have to kind of end up working together to try to make sure their industry survives. So really knowing the industry news on the business side, getting strong, maintaining and keeping strong relationships with respect to the people that you're working with, and just within that supply chain, and reaching out and really visible within that supply chain is really important, right? Because the more that everyone around you sees what you do for the rest of that supply chain, the easier it is to get for everyone. Everyone within that chain will end up throwing some money in or providing some credit relief or something in order to help the whole enterprise survive. You're on mute. Yeah.
Sorry, guys. I mean, those are really great points and really good strategies going forward. It's really about, also being creative and collaborating as much as you can with the suppliers and all the other stakeholders that Since we're running a little bit short on time, I have one last question for you guys, and that's, how does this current economic impact differ from the 2008 financial crisis? We've seen a lot of unprecedented stuff, right? What are some of the lessons learned from 2008 that we can apply here?
I'll begin with that. This is really a Main Street problem. That this is not a Wall Street problem. So it's tough to even to understand where the problems really begin, because unemployment is relatively very high from where it was months ago. A lot of the businesses that are in trouble are actually in towns and cities, local towns and cities. The banks really don't have a cash or liquidity issue. So a lot of them are actually willing. The reason they were able to do the SBA is because their systems are in such a good place that they could provide liquidity. People don't realize that the country was able to provide, I think, $3 trillion of financing within weeks, which actually cannot be done really in any other country in the world. We have a really, really robust financial system, which really saved not just the businesses, but also people, given the number of stimulus plans and checks that were delivered in 8 weeks or less. That's very, very impressive. And then the unemployment claims. So while all this stuff runs out, we probably will see a variety of problems, just pockets of the economy. It just won't be across the board. But we're seeing that the job market will probably be dislocated for quite some time. There will be definitely a problem for companies to rehire those same old positions. And I think the real problem is getting these old businesses out and new businesses in, which is going to be a 2-3 year cycle. So to speak about New York City, the commercial real estate market will probably be a ghost town for the next 2-3 years. I think there'll be avenues of streets that will just be empty of old businesses until new businesses feel comfortable to launch in waves. So it'll be some time. It'll take a few years for really things to get back to normal, but that'll just be entrepreneurs coming back and taking more risk. I think the consumers are definitely spending a lot of money across the board.
Yeah, just to echo, off of that, I think, obviously, 08, right? It was a credit crisis, right? I think, we were practicing bankruptcy law that it was really, you couldn't borrow money. It was just, the issue was top down. Here, it's kind of the opposite. There's a ton of money out there. There are investors are looking. The problem is the fundamentals. We don't know. Like, we just don't know what those businesses are, right? And to me, look, it raises a whole bunch of kind of just interesting overall economic and social questions of. So then, who's going to make the decisions? What's the country going to look like? When all those avenues start filling back up, who is guiding that money, right, into those streets, right, and back into Main Street and into the small towns in America, like, all of that to me remains to be unseen, because obviously we still don't know where things will be, even 3 months from now, right? And obviously the election is going to have a big impact on all of this, right? All the regulatory issues and effects of government, all that trickles down as well to all of this. So it's really kind of an amazing confluence of events that have kind of left us here in this stage of uncertainty. And again, our vision here in terms of what I think is going to happen is just, we need time, and people need to buy time. And the most effective way probably to buy time for business is Chapter 11. Is to be able to have, a few months, and that, as Vince said, courts are more and more willing to kind of extend those time frames, allow you to have that breathing space, allow you to see what's going to happen with respect to the economy, with respect to how this country is going to look, and then try to make a decision on what plan to move forward.
Thank you, guys. And I think it's worth mentioning that it really is a huge benefit for bankruptcy to have that automatic stay provision. For those of you who are not as familiar with bankruptcy, that's one of the biggest benefits and draws for companies filing and for individuals filing, is that you do get a stay from all of the collection actions, from all the lawsuits to try and figure out ways to work out those issues. And that's definitely something that people are considering more and more now. All right, so without further ado, I think it's time for some Q&A here. So I'm going to check the chat. Great. All right, let me just double check here to see if there's any questions. I don't really see any. Oops, sorry about that. Okay, so let me see Q&A. Okay, I don't see any open questions for now. So I think the last thing that we should do is, we have 10 more minutes here, maybe just some of the general consensus here. It seems like, you know, a lot of it is unknown, it's uncharted territory. It seems like recovery will be somewhat protracted in some sense because we're reopening the economy, we're closing it back up, you know, if there's a rise in cases, and maybe all of this recovery hinges upon a vaccine, right? In which case, that recovery timeline is a little hard to predict because of that factor. Do you guys have any predictions in terms of, you know, whatever it is that you can say right now, what's going to happen in the next, let's say, 3 months? That's a big no from everyone. It's a wild, wild west here.
No predictions, only hope, I guess. You know, it's so hard, right? You know, even with the vaccine, like early on, my thought was, yes, vaccine. Once we get a vaccine, we'll all be all right. And then, you know, the more I'm reading and hearing about folks that, you know, people don't want to take the vaccine, people won't trust the vaccine. Like, how do we know? You know, there's all these other things that have gone into this. It just gets more and more complicated every day, every time I turn on the news, right? So yeah, it's no prediction on my end. Just hope that we get to a place where we can start getting back to some sort of normalcy.
Yeah, I think the only thing that will probably happen is that travel will still be low. Maybe it'll pick up for the holiday season. I think people will definitely will try to do more things socially outside and act like outside of work, but I don't think the work environment is going to pick up until sometime of 2021. So not much is going to change for the next 3 months. Vaccines usually take 24 months. So I know the media is talking a lot about bringing this stuff out and coming on board publicly, but it's too risky to publicly release something that hasn't been tested enough times. But on that note, people should probably take their flu shot, because that's going to be another concern that's going to, you know, happen when the cold season comes around the corner. So there'll be a lot of unknowns still, but at the end of the day, there's just there's not much you can do about the businesses. They're just going to have to keep the lights on until they can't, or figure out another strategy in the meanwhile.
Hey, Vijar, how about another another wave of PPP money? I've not been following any legislation. Do you have any insight on that?
That's a good question. So it's really unlikely that any business money, I think, will come out. I think so. There are a couple things that happened the last 6 months. One, the COVID cases. We're very fortunate that this crisis wasn't as bad as it was first released in March. You know, the number of deaths, it's definitely unfortunate, but it could have been much worse. Obviously, they were predicting some things in the millions for the U.S. alone. So one, we were lucky that it wasn't that severe. But what we learned was that the economy could really recover very quickly in a few months. So the businesses that were in trouble, they received their money and they survived for a couple of months. The problem is the recovery period, which is unknown. So the government right now has figured out, hey, a lot of companies that needed the money, they got it. The employees got paid. People actually got the stimulus checks in a timely manner. After that, the real problem now is actually 3 parts. It's first is some people that are still unemployed need extended unemployment claims. So they need additional wages because they can't get a job. So I think the next stimulus plan won't have anything for businesses. I think it'll have it for employees. It'll have it for municipalities like New York City and like the state of New Jersey. And the third one will be the hospital and healthcare systems that need the cash. So it won't be for the businesses or small businesses this time around, because I think they've done quite a bit for them already, and it's just it's up to them if they can survive or not. And
on that depressing note, it's time to wrap up this wonderful event. And best of luck to everyone. Thank you so much, everyone, for joining, and to the awesome panelists who imparted all of that wisdom and knowledge. And we hope to see you guys more at more Albany events.
Yep, and thanks for all the attendees. Thanks for coming.
Thanks, everybody. Have a great morning.
Thank you.
Take care, guys.
Bye, everyone.
Bye-bye.